Welcome to I Know IFRS Educational Fund Series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on international financial reporting standards IFRS through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions of set 1 to which the answers have been provided on IAS 32. This is standard on financial instruments presentation. Viewers or subscribers have 30 seconds to select or choose their answer to each question. The answers to the 10 questions are revealed at the end of all the questions. Please enjoy it. Question number 1. The standard establishes the principles for presenting financial instruments as liabilities or equity and for offsetting financial assets and financial liabilities is or are dash A. IAS 32, B. IFRS 9, C. IFRS 7, D. IAS 39, E. All of the above financial instruments are applied. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 2. Which standard complements the principles of recognizing and measuring financial assets and financial liabilities? A. IAS 39, B. IFRS 13, C. IFRS 9, D. IAS 32, E. IFRS 7. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 3. In individual financial statements where the equity method is applied, financial instruments regarding interest in associates or joint ventures are accounted for using dash A. IAS 32, B. IFRS 10, C. IAS 27, D. IAS 28, E. IFRS 9. Time counts. Ten seconds gone. Twenty seconds gone. Time up. Question number 4. IAS 32 applies to contracts to buy or sell a dash A. Non-financial item that can be settled net in cash. B. Non-financial item that can be settled net in another financial instrument. C. Financial item. D. B and C. E. A, B, and C. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 5. Which of the following is or are not financial assets or assets? A. Cash in the till. B. Fixed deposit placement. C. Non-facility balance in a current or checking account. D. Right of a debt factoring institution on an indebtedness. E. Treasury shares. Time counts. Ten seconds gone. 20 seconds gone. Time up. Question number 6. Costs incurred in issuing or acquiring own entity equity instruments are dash. Costs incurred in issuing or acquiring own equity instruments are dash. A. Expense in profit or loss. B. Presented through other comprehensive income. C. Considered in arriving at profit for the year. D. Considered in arriving at the comprehensive income for the year. E. Deducted from equity. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 7. Transaction costs on equity transactions that are abandoned are dash. A. Expense in profit or loss. B. Presented through other comprehensive income. C. Considered in discontinued operations. D. Amortized over a given period. E. Deducted from equity. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 8. When the conditions for offset are met, the net amount from the offset of a financial asset and a financial liability is presented in dash. A. Profit or loss. B. Other comprehensive income. C. Statement of financial position. D. Statement of cash flows within the appropriate activities. E. Statement of changes in equity. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 9. The transfer of a financial asset that does not qualify for derecognition is that the transferring entity A. Offsets the financial asset with the associated liability. B. Expenses the financial asset in profit or loss. C. Does not offset the transferred asset and the associated liability. D. Nets of the transferred asset from its retained earnings. E. Presents the net amount from the offset of the financial asset and associated liability in other comprehensive income. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 10. Changes in the fair value of an entity's equity instruments are dash. A. Recognized in profit or loss. B. Not recognized. C. Recognized as adjustment to equity. D. Presented through other comprehensive income. E. Accumulated in a separate component of equity. Time counts. 10 seconds gone. 20 seconds gone. 'Time up. We proceed to review the answers. Question number 1. The answer to question number 1 is A. IAS 32. The objective of IAS 32 is to establish principles for presenting financial instruments as liabilities or equity and for offsetting financial assets and financial liabilities. A is the answer to question number 1. Question number 2. The answer to question number 2 is D, IAS 32. IAS 32 complements the principles of recognizing and measuring financial assets and financial liabilities in IFRS 9 financial instruments. It, in addition, complements the principles of disclosing information about financial assets and financial liabilities in IFRS 7 financial instruments disclosures. D is the answer to question number 2. Question number 3. The answer to question number 3 is D, IAS 28. That the financial statements are individual financial statements is a direct pointer that they are neither consolidated financial statements nor separate financial statements. That the equity method is applied signals that investments in associates or joint ventures are neither accounted for at cost nor fair value, in line with IFRS 9. IAS 32 does not apply to financial instruments as interest in subsidiaries, associates, or joint ventures that are accounted for in line with IFRS 10 consolidated financial statements, IAS 27 separate financial statements, or IAS 28 investment in associates and joint ventures. D is the answer to question number 3. Question number 4. The answer to question number 4 is E, A, B, and C. IAS 32 applies to those contracts to buy or sell a non-financial item that can be settled net in cash or another financial instrument, or by exchanging financial instruments as if the contracts were financial instruments, with the exception of contracts that were entered into and continue to be held for the purpose of the receipt or delivery of a non-financial item in accordance with the entity's expected purchase, sale, or usage requirements. That IAS 32 applies to financial items is given. E is the answer to question number 4. Question number 5. The answer to question number 5 is E, treasury shares. IAS 32 provides that treasury shares, that is an entity's own equity instruments, are not recognized as financial assets. An entity that reacquires its own equity instruments is required to deduct those equity instruments from equity rather than recognizing them as assets. E is the answer to question number 5. Question number 6. The answer to question number 6 is E, deducted from equity. Costs incurred in issuing or acquiring own equity instruments are transaction costs. Transaction costs are accounted for as deduction from equity to the extent that they are incremental costs directly attributable to the equity transactions that otherwise will have been avoided. E is the answer to question number 6. Question number 7. The answer to question number 7 is A, expense in profit or loss. The cost of equity transactions that are abandoned are recognized as expense in profit or loss. A is the answer to question number 7. Question number 8. The answer to question number 8 is C, statement of financial position. When and only when an entity currently has a legally enforceable right to set off recognized amounts and intends to settle on a net basis, or to realize the asset and settle the liabilities simultaneously, a financial asset and a financial liability shall be offset and the net amount presented in the statement of financial position. C is the answer to question number 8. Question number 9. The answer to question number 9 is C, does not offset the transferred asset and the associated liability. In accounting for a transfer of a financial asset that does not qualify for due recognition, the entity shall not offset the transferred asset and the associated liability. C is the answer to question number 9. Question number 10. The answer to question number 10 is B, not recognized. Changes in the fair value of an entity's equity instruments are not recognized in the financial statements. B is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IAS 32 Financial Instruments presentation. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all the standards in this framework and create further sets of question and answers on standards already covered. For collaboration in this area, please call our WhatsApp +2349 030 770109. All rights to the production and others in the service are reserved for OJ Inspiration Limited. Thank you once again, and bye for now.